Over the last quarter-century, the global private equity index has outpaced the MSCI World Index by 500 basis points annually, net of fees. Anita, why do you think this performance gap exists?
The real strength of private equity lies in its hands-on management style. Unlike public investors, PE managers dive deep into corporate strategy, restructuring, and align closely with management teams, aiming for value creation beyond just financial returns.
Right, and public markets often lack this degree of involvement. Instead of shaping companies' strategy directly, public investors might only nudge the strategic direction, without the daily operational engagement seen in private scenarios.
Absolutely. This strategic depth in private equity translates into tangible outcomes such as higher revenue growth and profit margins. That's evidenced by firms like KKR, whose success largely hinges on comprehensive value creation strategies.
So the big question, does private equity's historical outperformance suggest continued success, or is the landscape changing? Given today's tighter liquidity and cautious market sentiment, could these conditions actually benefit private equity firms? What do you think, Anita?
These conditions might actually give disciplined firms an edge. With more reasonable valuations, it's becoming a buyer's market for PE managers who can strategically deploy dry powder, the capital that awaits investment.
It reminds me of the early buyout boom, though the interest rate landscape is different now. Still, the contraction of public company numbers, from over 7,000 in 2000 to 4,500 today, suggests more firms staying private increases PE opportunities.
Moreover, with public equity returns historically brightening private equity prospects when muted, the current forecast aligns perfectly for PE to possibly outperform once more. Anita, hadn't you mentioned some insights about IPO activity?
Indeed, IPOs and other capital market activities are languid right now, which means fewer exits, but also the potential for acquiring quality businesses under favorable terms. That can plant the seeds for lucrative private equity vintages.
Contrary to belief, dry powder levels relative to the U.S. market cap remain stable. Plus, as capital markets activity is low, valuations still provide attractive entry points, which historically is when private equity thrives.
And speaking of attractive deals, the rise in take-private transactions and corporate carve-outs can't be ignored. Companies divesting non-core segments offer great transformation potential for private equity.
Exactly, and with public markets heavily concentrated on a few tech giants, private equity not only skirts concentration risk but also offers a broader diversification and control strategy.
Thus, with these factors in mind, would you say private equity saturation is less about volume and more about strategic positioning? With public markets trading at high valuation percentiles, is now a prudent time for long-term investors to consider private equity, Anita?
Given the S&P 500 is at the 96th percentile of its 20-year range, whereas private equity deals are occurring around the 47th percentile, it seems like an opportune moment. Emphasizing value creation, not just market timing, will be key. Absolutely. As public returns project modest growth, seasoned investors may find private scenarios particularly compelling, especially if they adhere to disciplined strategies focused on implementation and expansion.
In conclusion, as we explore the evolving landscape, ongoing research by thought leaders such as KKR's Alyssa Wood and Chris Harrington points to a nuanced future for